How's it going, guys? My name is Jared Ace, and welcome back to MoneyMetEish. This is the May review for the MoneyMetEish EasyEquities portfolio, and May was a strange month that somehow felt both extraordinarily quick and never-ending. As you might know, we're busy planning for our trip home to South Africa, and so I've not really given the portfolio any attention, at all. And over the last 2 months, I've added a whopping total of 1,000 Rand into the account, which I did as a test to see if I was able to send funds from one of my bank accounts outside of South Africa to the portfolio, and I was. We're also starting a separate YouTube channel where Mrs. MetEish and I will be sharing more of our daily lives and our adventures, but more about that at a later date. This video, as with all my videos, is meant for edutainment purposes only and should not be used as the basis for any financial or investing decisions, as I'm not a financial advisor, this is not financial advice, and this is a blank cup. Blank cups. Put your logo on my cup. For more information about blank cups and how to work with MoneyMetEish, contact us via our email at MoneyMetEish@gmail.com. EasyEquities is currently running a massive giveaway. To enter the competition and stand a chance to win your share of 1 million rands worth of prizes, all you need to do is successfully refer one person who will sign up and activate their account. That's it. If you still haven't signed up for EasyEquities, follow the link below and start your very own investing journey for as little as 5 Rand. Once you've done that, you can get your referral link and sign up one person of your very own using your referral code, and you're in the competition. Without any further ado, let's begin, as always, with looking at the US account. The US account, which was once the source of most of this portfolio's growth, has become a major source of pain in the last months. For the month ending May 31st, the account is down 5% from the previous month, which is actually up almost 10% from the lowest point we saw during the course of the month, when the account went negative for a few days. Year to date, the account is down 13%, which is 14% lower than the benchmark for the account, the S&P 500. We are actually still beating the S&P 500 over 1 year though, but just slightly. The S&P 500 over the last year is down 2.8%, and our US portfolio is down 1.2-ish%, so we are losing money. But we're losing money at a more impressive rate than all those expensive fund managers who don't even beat the benchmark, so that's the real flex here. The winner for the month is BlackRock, up an almost unbelievable 7.1%. I say it's unbelievable because 2/3 of the account ended the month negative, and the next best monthly gain was Lockheed Martin at 1.8%. BlackRock is a very complicated company to fully come to terms with. On the one hand, it's the world's largest asset manager with over $10 trillion in assets under management. That's trillion with a T. On the other hand, it's often referred to as the most powerful company, the most evil company, or many other nasty names depending on your political affiliation in the world. BlackRock is best known as the company that owns iShares, which many investors will be familiar with as they operate a number of ETFs and index funds. Our Taiwan ETF, for example, is also operated by iShares. I can see how it isn't a company for everyone to want to hold, and that's perfectly fine. Either way, it is our top performer for the month. The biggest loser is Cloudflare, who, over the course of just this month, has lost 1/3 of the market cap of the business, with the share price falling a staggering 35% in May and 56% year to date. With the rising interest rates, investors just aren't willing to take the same level of risks as they were during the low-interest environment we saw globally because of the pandemic. This flight to safe havens has meant that many great companies have been beaten down during the last month, with big tech seeing some of the most violent drawbacks, and of course smaller, innovative companies have been beaten down much harder. especially those companies who, like Cloudflare, are not actually profitable or massively cash flow generative. When cash flow machines like Google and Apple are being beaten as badly as they are, you can only imagine the beating the smaller guys whose market caps are lower than the cash and cash equivalents that these big tech companies keep on their balance sheets all the time are taking. I mean, you don't have to imagine, you can just search the name of any innovative company over the last 2 or 3 years and you can see exactly how they're faring. One thing I find baffling is just how much some companies have been impacted by the results of other companies. Walmart, for example, announced some pretty blech numbers, and Costco fell 15%, even though they actually operate with completely different business models. And most baffling of all, Costco increased year-on-year sales for May by 16%, and saw an increase in sales from April to May of 17%. So somebody circle that square for me. I just wish that I had more money to buy Costco stock at the moment. But you might, just like me, be looking at your portfolio and thinking, what can I do in this situation? And I will tell you exactly what our plan is for the remainder of the year at the end of this video. There are some really great companies on sale at the moment, but there's also a lot of cuck companies that have fallen from levels that they should never have been at to begin with. Your challenge now, should you choose to accept it, is separating the quality from the cuck. Being down 30% year to date is a serious kick in the nads and a rude awakening that I guess I needed. It certainly has made me question myself a lot over the last few weeks. It is a stark reminder that I'm still very green in terms of investing, and it lays ahead a daunting education. They do say that pain is a brilliant teacher after all. Now, onto an account which is not so painful to look at, the TSAR account. Despite the TSAR account being down a nauseating 13%, yes, 13, in May, we're actually still up 7.5% for the year, which means we are still beating the benchmark for the account, the Satrix 40, on a year-to-date basis, and quite handsomely at that, having seen an 11.5% return compared to the Satrix 40's minus 3.97, let's call it 4%, minus 4% return for the same period. The account actually looks even better when compared to the benchmark over 1 year, having achieved 40% alpha, which, I'm not gonna lie, has taken me by surprise. With the TSAR account returning 42.98, let's call it 43%, versus the benchmark's return of 2.5%. I guess, when in doubt, zoom out. I don't know if that applies here, but I'm gonna stick with it. The winner for the month is my favorite Redefine Investments, who ended the month by releasing their first set of full-year earnings since listing. They were also the only holding in the account to end the month positive, gaining 1.16% in May. The loser was Purple Group, who fell 9.7%, as we saw a further increase in interest rates by the South African Reserve Bank during the month, and little indication that this will be the last such hike, as inflation globally still rages on, although South Africa has fared much better than most of Europe and North America, and central banks look to stabilize their inflation rates while not sending their respective economies into recession, in which many investors seem to think is a full-blown conclusion. All of these factors pose rather serious headwinds for the company, as fewer South Africans have disposable income to put into the markets, and that's before we even begin to look at factors such as increased food insecurity and countries banning exports of various foodstuffs and the P word, petrol. And now on to our final account, the tax-free savings account. There really is very little to say about the tax-free savings account. It's down 3.6% this month. It's underperformed the Satrix 40 by 17% year-to-date and 5% over a year. There's not much to write home about. It's a bunch of ETFs. The market in general has been nauseating, and so should have sold the Signia Fourth Industrial Revolution when I had a chance. I feel like the chance to sell is gone. I'm in the hole. I'm just gonna sit here in the sad, damp hole and be sad. I guess, that's what I'm doing. The winner for the month was the MSCI Taiwan ETF, which was up 2%, yay! While the loser was the Satrix Nasdaq 100, which ended the month down 6.3%. Overall, the portfolio fell 7% in May, from an opening total of 91,779 Rand to a closing at the end of the month of 88,275 Rand. And I did add another 1,000 Rand to the portfolio. It all went into buying core shares global and barely made a dent in the losses. So what are we gonna do in this situation? What can you do in this situation? What are the MetEishes doing with our money at the moment and for the remainder of the year? For starters, like I said earlier, we have been focusing entirely on getting to South Africa to see our friends and family. We haven't been home in over 3 years, and it's costing us an arm, a leg, and a hippopotamus to make it happen. No hippos were harmed in the making of this trip. We have spent all of our energy over the last 3 months, firstly paying off debt, and all of our other money after that has gone towards our trip. We even cut our monthly budget by 50% in March and April, and a further 10% in May, which is going to continue now in June, just to make it happen. When we get back to Taiwan, we will both be starting new jobs, which is very exciting and comes with a very nice 50% increase in household income, as well as allowing us to spend more time together. Aww. We have found, though, that we are actually able to survive just fine on our new budget, which means we will be living on roughly 30% of our income. The remaining 70% will go towards, firstly, paying off all of our remaining debt, and once that is done, we will be funding our full 6-month emergency fund and then maxing out our tax-free savings accounts, making our first investment with Orbvest, and from there, we will be funding our EasyEquities portfolios again, while saving for our next big goal, which you will have to wait a little bit longer to find out what that is before we announce exactly what it is. In the current environment we find ourselves in, with rising interest rates, the best thing you can do is pay off any and all debts first. Make sure that your household is in order, you got your 4 walls covered, like Uncle Dave would say, and you are paying off your debt, especially unsecured and non-productive debts. Any credit cards, store cards, car loans, they need to go as soon as possible. After we have paid off our debt, we will continue to dollar cost average or rand cost average into ETFs in our tax-free savings and TSAR accounts. Thanks for watching, guys. If you like this video, please give it a thumbs up, comment and subscribe down below, and ring the bell to be notified whenever we upload new videos. You can also follow MoneyMetEish on Facebook and Instagram and everywhere where MoneyMetEishes are. If, like us, you would like to invest with Orbvest and get your little piece of some medical real estate in the USA, you can fill in the form in the description down below, and a consultant will get in touch with you with all of the information about Orbvest and their products. Thanks for watching, and happy investing.